This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead. With insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. We are in San Francisco, on TV, on radio, on Bloomberg Originals, and of course on YouTube. And Tim, how the sentiment has changed again.
It's an interesting trade to say the least, Carol, and we're going to have much more on the trade in just a few minutes. But just to really bring everybody up to speed, if you're just now tuning in, sentiment changing, hiring surging in May, boosting bets on a Fed rate hike. Tech stocks really dragging on the NASDAQ. The SOX having its worst day in many months at this point.
Yeah.
NVIDIA, Broadcom, S&P 500 is actually on track for its first weekly decline after 9 consecutive weeks of gains.
It's been quite a run, a record run, a run that we haven't seen on the S&P in a long time, but a very different tone as we get ready to wrap up on this Friday. Hey, so ahead this hour, yes, of course, we're going to talk about that monthly jobs report. We're going to talk about U.S. rates. We're going to talk about the Fed policy, what you need to know. We've got a roundtable coming your way in just a moment.
On markets, John Flood, Goldman Sachs, head of America's Equities Execution Services.
He doesn't do TV a lot, from what I understand.
No, we're looking forward to that. Natalia Kniazhevich is going to be joining us on that as well.
All right. Plus the World Cup, it is kicking off next week. You know that. In the U.S., across Canada, Mexico. Get ready for gridlock. Get ready for more subway runs in New York City. And also get ready for heightened security presence and some concerns. So we're going to tackle that part of the event with Dan Arnold. He's Senior Vice President of National Operations at the security firm Protos Security. Our own Vanessa Perdomo is going to be along too. She, of course, co-host of the Business of Sports podcast. So she's been leaning in all in when it comes to the World Cup.
Yeah, looking forward to all that and more coming up for the next hour right here on Bloomberg Business Week Daily. First up, though, a check on the day's trade and top business stories. Charlie Pellet holding down the fort in New York. Hey, Charlie.
Indeed, looking at a down day, Tim and Carol, with the Dow, the S&P, NASDAQ very much in the red. Going to get right to the numbers here because we've got some fast-moving markets. Keep it locked in to Bloomberg to find out how things shake out ahead of the close, ahead of the weekend here. S&P at 74.59. Got to keep in mind this week we had a record above, and in fact a close above 7,600 on the S&P, but 74.59 where we stand right now. We're looking at a loss of about 1.6%. The Dow, which surged yesterday at a record, it is down by 375 points, down 0.7%. Let's get to where the real damage is, and that is in tech land. NASDAQ 100 index now down by 3.2%. The NASDAQ Composite Index down 2.8%. Among some of those tech names, Micron down now by 9%, NVIDIA down 4.9%, Broadcom down 6%, and Advanced Micro Devices down 8.8%. The SOX, as Tim mentioned, the Philadelphia Semiconductor Stock Index down 7.5%. All of this with a VIX now at 18, a 10-year at 4.54%, a 2-year 4.16%, and the 30-year 5.00%. Gold down 137 the ounce, 43.37. That is a drop now of 3.1%. West Texas Intermediate crude 90 even a barrel. It is down by 3.3%. Brent 92.95. The global benchmark down by 2.2%. Interesting day for Bitcoin. Was trading below $60,000. Bitcoin now at $60,781 for Bitcoin. That is a drop right now of 4.4%. One bright spot, Dow Transports. They are advancing. Dow Transports up today by 1.3%, being led higher by FedEx Freight, Union Pacific, and Northern Southern. Chicago Bears planning to leave Illinois. They're heading to Indiana after over 100 years. Team intends to build a new stadium in Hammond, Indiana. The exact site, though, yet to be selected. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Just a quick correction. I was talking about the SOX earlier, Carol. I was saying it's having its worst day. It's actually having its worst day just going back a couple weeks. I was thinking of Broadcom, which is having its worst 2-day stretch ever.
Yeah.
Shares are down about 20% just in the last 2 days.
Well, it's kind of hard to keep track, right?
A component of the stocks,
These names are on the move, and they've definitely been some outperformers. But for Broadcom, it's certainly a very different trend over the last couple of days. All right, as you know, folks, as Charlie just mentioned, we are seeing stocks and bonds. They are falling after that solid jobs report. And it really added to speculation that the Fed's next move would be a hike in interest rates. I got to say, I want to pat us on the back a
Oh,
little bit.
how come?
We have had guests, and we've talked about whether or not the markets are underestimating the possibility of a rate hike later this year.
Yeah.
So just calling that out.
Okay. Kudos. Congratulations to you and to our guests.
To us,
I
yeah.
won't take any credit for this.
I don't know. It's Friday. I'm tired. I'm going to take some credit. Hey, as for the numbers, U.S. job growth topping all forecasts in the month of May. The unemployment rate held steady at 4.3%, offering the clearest sign yet that the labor market here in the United States may be breaking out of a prolonged period of lackluster hiring, Tim.
President Trump's chief economic advisor, Kevin Hassett, director of the U.S. National Economic Council, joined Bloomberg earlier today on the U.S. labor market.
We're getting positive jobs numbers because we've got high wage growth, and native-born Americans are rushing into the labor market in droves. And so that negative story is gone. And finally, I got to say, we really love going through the Bloomberg data, and we have this thing that I like to look at, which is the probability distribution of all the forecasts for the jobs number before it comes out. And when I looked at it after I got these numbers, I saw that the very, very top person was low by about 40,000 jobs, which shows that the Trump economy is surprising Wall Street analysts over and over again, and they need to maybe think about getting the supply side of their model fixed.
All right, that, of course, was Kevin Hassett, director of the U.S. National Economic Council, earlier on Bloomberg. Let's get more to our roundtable. Thanks to our roundtable, I should say, on jobs rates and the Federal Reserve. With us back home on the East Coast is Michael Mckee, Bloomberg TV and Radio international economics and policy correspondent, and, of course, Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist. Mike, of course, on set back in our Bloomberg New York headquarters. Ira out there at our Bloomberg Princeton bureau. Hey, Mike, gotta set it up for you. This is like, I don't know, prom day for Michael Mckee and all of us who watch.
He gets to go to prom every month. That's not fair.
Yeah, and then some. Walk us through the data, what it says more broadly about the U.S. labor market, and then also what it says about the U.S. economy, Mike.
Well, it's definitely a strong report. There's no denying that. And it does suggest that the labor market has at least stabilized and might be starting to show signs of expanding. It may be that a lot of the people who, a lot of the companies who had held off on hiring because they weren't sure what was going to happen with tariffs and with the war have finally decided, well, we need to make some moves and we're going to add some people. It may also be that this was seasonally affected because there was a big gain in the local governments, which may have been related to the idea that school's coming to an end. Big gain in leisure and hospitality, more people working at restaurants and bars, amusement parks, things like that. So we can't say for sure that this means that we're out of the woods, but it does mean that the people like Kevin Hassett can take a bit of a victory lap for the time being.
We're going to get to more of Kevin Hassett's comments that he made to Bloomberg earlier, Mike. I want to ask you something about that in just a few minutes. That's a little bit of a deep tease. And we're going to talk rates, too, with you, Ira. But before we talk rates, because we got a good bit of time with both of you, what stuck out, Ira, for you with today's report?
Yeah, well, one of the things is, firstly, is that there's really only two sectors that really participated. And like Mike said, one of those sectors was leisure and hospitality. And, you know, we don't know, was some of that pre-hiring hoping that the World Cup is going to bring a lot of leisure and hospitality jobs to certain areas of the country? We'll get that when we see some of the detailed data at the state level. So that'll be pretty interesting to see if that's actually what's going on or if it's a broader rehiring for leisure and hospitality seasonally. The other thing that stood out to me was the fact that wages were still okay, right? One of my fears has been that, okay, we might be hiring more people in the healthcare sector, but maybe we're paying them less, so that just incentivizing companies to be able to hire more people. But you didn't quite see that, so the wage data was still okay.
Hey, Mike, I promise we get to some of Director Kevin Hassett's comments earlier. Something stuck out to me from that clip that we played. He said, native-born Americans are rushing into the labor market. Is there data that shows that that's who are getting jobs right now and not immigrants?
No, there's not data like that. There is data on who holds jobs, the overall number of people who are foreign-born and the overall number of people who are native-born here in the U.S. But it's not a count month to month where they add up the number of people who have recently moved into those jobs. It's just a total, and one side balances the other. They have to divide the total number of jobs by that. So by just mechanically, if one goes up, the other goes down. So we don't see any real evidence one way or another that people are native-born Americans are rushing into jobs that foreigners used to hold. What we do see is that the labor force has fallen by quite a bit. This was the first month in about 6 where the labor force actually grew, but only by 83,000. So we are seeing the impact of the immigration policies, but it's not something that suggests that we're seeing an awful lot of native-born Americans crowding out immigrants.
Is that narrative, though, Mike, the idea of native-born Americans getting jobs, is that, I would imagine, and look, I think everything's political in this day and age, even numbers that we get and the commentary around numbers from officials, but it just seems like that to me is a politically charged statement, and I'm just wondering, as somebody who looks at the economics of this, what you make of that narrative that's emerging.
Well, there are two ways to look at it. One is an economic way of looking at it, which is that we need fewer jobs to keep the unemployment rate stable, and that's one reason it remains so low, because we don't have very many people coming into the labor force right now. And to the extent that there are being jobs created, that creates more demand for workers. The other side of it, though, is the political side, and although, as Ira mentioned, we didn't see a collapse in wages, the year-over-year annual rate of average hourly earnings fell to 3.4%. That's a 4-year low. And that suggests that people's incomes are not keeping up with inflation, because the CPI and PCE running over 4%. Which means that there's a political issue coming up for the administration this fall. Even if jobs are being created, if people feel they're falling behind because inflation is winning, then they're not going to be happy about that.
I keep reminding everybody, I'm back from a family wedding in Oregon, and everybody who was under 30 was talking about high gas prices and how expensive everything costs.
Oh, they should come look at the gas prices here in San Francisco.
But I'm just saying, it's on everybody's mind. Ira, you got to come back in, because I want to talk about what traders are expecting in terms of U.S. rates. Kevin Hassett, again, President's chief economic advisor, saying that investors are incorrect in interpreting the strong May U.S. jobs report, suggesting the Fed will have to raise interest rates this year. He says, I think that's terribly wrong. And he says what you need to do is look at the impact of oil price shocks on core inflation, and the history of it is that they are temporary. They don't lead to lasting inflation. Yeah, we thought it was temporary back in February and March, but here we are in June, and we're still talking about higher energy prices. Is Hassett wrong on this?
Well, the market certainly thinks he is, and when you look at what's gone on with the front end of the yield curve, with 2-year notes up, as well as other short-term interest rates, the market is now pricing for an interest rate hike by the end of this year. I don't necessarily think that it will occur, because I think what the market's really pricing here is, let's just call it round numbers, basically a 50% chance that they might hike by 50 basis points and a 50% chance they leave things unchanged. So the average of that, the weighted average of that, is 25 basis points. And I think that's where the market kind of is right now. And talking to investors after this call, there's a number who say, things are strong now, but look, it's low wage sectors, which is going into what Mike was just talking about with wages not growing very quickly. The jobs are in lower wage sector as opposed to technology or financial services, which over the last year both have seen pretty big job losses. But the people are thinking that, hey, maybe the Fed will have to hike, because if the war is like low intensity and prolonged, and we continue to see gas prices over $4 at the pump, that is going to have an effect on people's expectations for inflation, and that's why the Fed would ultimately hike.
Ira and Mike, you both are super smart and always reminding us this is 1 month's report. We also get reads on inflation next week, CPI and PPI, and then we're coming up against the first Fed meeting that will be overseen by the new chair, Kevin Warsh. Ira, let me come back to you, though. You do remind us, 1 month's report, there's a lot that can still happen over the remaining, 6 or so, or 5.5, 6 months here of 2026. That's important to keep in mind. The narrative can change again.
Yeah, I mean, I think it can change again. And when you look at what the inflation swap market is pricing, they're expecting this next CPI report to be the high. So the market is pricing around 4.3% for this month, but then under 4% going forward on a year-on-year basis. So that means that the market is still anticipating, somewhat lower inflation on a going forward basis, and that has to be driven by energy. And part of that is kind of very technical because the oil futures curve is still backward sloping, right? So the market is still thinking that, hey, oil and gas prices are going to be lower in 2 or 3 months than they are right now.
Hey, Mike, come on in on it. Same thing for you. I mean, there's a lot that's going to happen still potentially over the next 5 to 6 months. If I look back at the first 5 to 6 months of this year, there's a lot of things that were not on my expectation list. A good reminder, and take us to the first Fed meeting of Kevin Warsh. There's nothing he can do but leave rates alone. Is that fair to say as well?
That's fair to say. And I would just add what I have always said is you can invest in Fed funds futures if you want, and they go up, they go down, you make money off of the movement, but they don't tell you anything about what's going to happen until you get maybe a day or two out of a Fed meeting, because everything keeps happening and we get different economic data and it changes the market's mind about what they think the Fed will do. Now, as to Kevin Warsh, he's coming into a difficult situation because all of the economic data now is pointing in away from the direction of rate cuts. A job market that is strong like this is suggesting that there's not a problem with the overall economy that needs to be solved by lower interest rates. And higher inflation, in theory, if it starts broadening out beyond energy, would call for a rate increase. We had Beth Hammack, the Cleveland Fed president today, put out a statement that said, great news about the jobs numbers, but if we don't see inflation come down, we're going to have to act soon. She's one of the more hawkish people, but you do see this idea that we're maybe looking at interest rate increases starting to gain some power, some attention in the markets and among Fed people. So Hassett comes into his first meeting. If he wanted to cut rates, he'd be in the minority. And so I assume that he will not vote for a rate cut and dissent at his first meeting. And so basically what we'll have is the Fed takes the forward guidance about rate cuts out of the statement and not much else. And then it'll all be about Kevin Hassett. It'll be like a movie review. How did he do in his role as Fed chair? Did he defend the institution? Did he stick up for the other people on the Fed? All that sort of thing, rather than the market trying to decipher what it means for interest rates going forward.
I'm already getting my popcorn ready for that first Fed meeting. I can't wait with Kevin Warsh. Having said that, there's this narrative going on in terms of the U.S. economy, and then there's the AI spend, which we spent a lot of time talking about at Bloomberg Technology yesterday, our summit, our annual summit. We've got a headline from the FT, Meta weighs raising tens of $billions in a new share sale, so a new stock offering. One would assume that we are now seeing these big hyperscalers, Tim, these big tech companies, they've been tapping the debt markets to fund the expenditures when it comes to building out the AI networks. Now they're also doing equity plays.
You're actually seeing Meta shares take a hit right now, just falling substantially, down 5.5% as a result. Once again, that headline crossing the Bloomberg terminal that Meta weighs raising tens of billions of dollars in a new share sale reminds me of what Alphabet did earlier this week.
Hey, Mike, just 30 seconds before we go. AI and productivity. Mary Daly of the San Francisco Fed addressed it yesterday. She's, looking at it. 20 seconds here. Is that a big deal yet in terms of the labor force? Real quickly.
No, as she said, it's not yet. You really don't see a lot of evidence of it in the data. It's the main reason that Warsh argues you can cut rates going forward, because productivity will go up, but we don't see it yet.
All right, Michael Mckee, Ira Jersey, you guys rock. Hey, coming up next, folks, we move from the economy to the markets and all of this. John Flood of Goldman Sachs joins Tim Mee right here on Bloomberg Businessweek Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Meta Platforms said to be weighing an equity raising. That, according to the FT, Meta has not yet hired banks for a possible equity raise, according to the FT. Meta shares, though, moving lower, down now by 6.9%. All of this as the Nasdaq 100 index now sinks by 3.9%. Fed hike wagers lifting yields. The S&P down 154, down 2%. The Dow down 451, drop there of 0.9%. Nasdaq is down 3.5%. The Nasdaq 100 index down more than 1,100 points, a drop there of 3.9%. Nasdaq, by the way, is down more than 930 points. All of this as losses intensify. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down by 8.5%, and the VIX closing in on 19. A 10-year at 4.54%, the 2-year 4.16%, and the 30-year at 5.00%. Spot gold down $147 the ounce to $43.26, drop there of 3.3%. West Texas Intermediate crude holding just above $90 a barrel, down 3.2%. Barrel of Brent, 92.96. Brent crude down now by 2.2%. Bitcoin had been trading below $60,000 a token. Right now it's $60,355 on Bitcoin. It is down by 5.1%. Chicago Bears planning to leave Illinois and head to Indiana. After over 100 years, the team intends to build a new stadium in Hammond, Indiana, with the exact site yet to be selected. But a source tells ESPN it is not a done deal yet, and Illinois can, quote, still get back in the race. Recapping, S&P down 154, drop there of just about 2%. Back we go to San Francisco, and once again, your hosts, Tim Stenovic and Carol Masser.
Wait, did you forget us, Charlie?
He would never forget us.
No, you're allowed. It's a Friday, man, and it's been another crazy week.
It was a dramatic pause. That's what it was, to call attention to our two glorious hosts.
Well, you are always glorious. Our lovely, lovely Charlie Pillett back at Bloomberg headquarters in New York City keeps us honest. Hey, as you know, trading news, a lot of things keep us honest, and all bullish things must come to an end. We're certainly seeing that in the trade today, Tim, or at least a little bit of a breather.
Yeah, as we've been reporting, as you just heard from Charlie, Wall Street's historic weekly run poised to come to a halt. Stocks and bonds falling after that solid jobs report added to speculation that the Fed's next interest rate move could actually be a hike.
All right, so let's get into the trade now that we know what the backdrop is right now. Natalia Kniazhevich is with us, Bloomberg News equities reporter. She's back at home base at Bloomberg headquarters in New York City, along with John Flood. He's Goldman Sachs partner and head of America's Equities Execution Services. As we said, both back in New York City.
Hey, John, Natalia, good to have you both with us. John, I just want to get your thoughts on where we are in maybe a cycle here. And I'm struck by the news of Meta Platform shares down right now, the company weighing a big equity raise after that blockbuster Google deal that we got earlier this week, $85 billion in a share sale. John, I know I'm not going to get you to comment on an individual company, but comment on what it means to you when you have huge mega cap tech companies doing share sales or possibly doing share sales like this. What signal does it tell you?
Signal tells me that it's a very healthy market right now in terms of the supply and demand that's out there in the marketplace. And I think that we've seen, I speak with institutions at Goldman Sachs, institutional investors, and there's never been more robust demand for these offerings. And my expectation is that trend continues. And that's a major piece of why we are very constructive, this equity market. Despite S&P 500 already making 24 all-time highs, we expect more of that to come in the future.
So, John, how do we know, though, that it isn't just a case of FOMO and people just chasing? I mean, it's so much money, so much momentum in terms of the AI spend and build, debt side, equity, tapping markets. We heard from the Bloomberg technology folks yesterday, a big conference, lots of major players in the AI space saying demand is incredible. They just the momentum. How do we know, though, that it's not just kind of a major, major FOMO trade and that there's going to be some kind of reality or reckoning coming in the near future?
because from the institutional investor perspective, we actually still see a lot of discipline out there. There's still, I think, a wall of worry left to climb higher in this market. What we look at is our prime brokerage data. And one of the most important pieces out there right now, I think, is gross exposure. So essentially, hedge funds are still long a lot of their single stocks, AI, tech exposed names. They're also more short macro products against these longs than they ever have been in the history of our data set. What that tells me is there's still healthy skepticism about what is going to happen next. I want to hold my longs, but I want to make sure I'm hedged. And it's essentially the most hedged we've ever seen hedge fund clients at Goldman Sachs on the equity floor.
John, what is your take actually on today's stock market sell-off? Because we hear lots of conversations about some market participants, taking profits off the table because they're prepping for this huge wave of big tech IPOs. So what is your take? And what does Goldman also think? Is it a buying opportunity? Is it time to buy the dip?
I think that there have been few and far dips to buy so far this year. So yes, when you have a 2% sell-off in the S&P 500, it has paid to buy those dips, and I think I think that will continue. I think today you have some profit taking into the weekend ahead of what is likely going to be continued supply, as evidenced by the news that just broke. But really, we had a strong jobs print this morning. And I would say, what are the fears that people continue to list as top concerns? It's inflation, it's Iran, it's private credit. And this morning's jobs print, has rates moving higher, and people now think that we will get a rate hike and by year end. So I think it's healthy. I do think it's a buying opportunity, and I think that there is still a significant amount of worry, cash on the sidelines, short exposure out there for the market to climb higher.
Got it. I also wanted to ask you about one indicator tracked by Goldman Sachs. It basically tracks all positioning across hedge funds, long-only investors, retail funds. It is interesting because the stock market is at all-time high. At the same time, positioning is still at a neutral level, which means that there is more room to run. So first of all, please tell me, why is that? Why positioning is still so low, and what it means for the stock market direction?
It's likely a tailwind, and that's exactly what we said. Despite us being close to all-time highs at the index level, from an institutional investor perspective, there is still concern out there. We see that through gross exposure being at all-time high, expressed through a lot of short hedges in macro product, and from mutual fund cash balances. If you look at notional dollars that remain on the sidelines for mutual funds, we are still at a long-term average. It's not like it's not an outlier. So when you look at hedge fund exposure, you look at mutual fund cash, there's still plenty of skepticism left out there. That's why our sentiment indicator is showing healthy positioning, not overextended positioning.
John, that makes me happy that there's some negative sentiment out there. I get very nervous. We're just at this tech event. We talked a lot about AI. Hochul of Broadcom was here. I mean, all of the major players. And there was a lot of enthusiasm, I think it's safe to say, with some cautiousness, but a lot of enthusiasm. Having said that, because of what you are seeing, particularly among institutional investors and hedge funds, do you think the retail investor and markets overall are not really thinking that we could see some kind of pullback or mini correction as a result?
I think that there is a slight disconnect between the retail investor right now and the institutional investor. That being said, I think that retail will continue to buy the equity market as we have some mega cap IPOs likely in the pipeline between now and year end. We'll see how that plays out. But these are high-profile companies that typically grab the attention of retail. And once retail starts buying, they don't really stop unless there is true job loss. Our data shows that retail bid disappears when there is job loss. And the last time that we saw retail as a net seller of the U.S. equity market for more than a consecutive week was back in March of 2020 during the depths of COVID. So wow. It really, you have to watch employment, you have to watch jobs, and until we start to see job destruction, that retail bid will likely remain a healthy constant in the marketplace.
Well, we certainly got a positive print today in that arena. John, I'm wondering though, what would give you pause apart from job losses? What would give you pause with an equity rally such as this?
If we started to get disappointed in earnings, and frankly, we continue to see companies clear these hurdles. Last quarter, earnings were solid. We are optimistic about next quarter. If you start to see earnings holistically across the S&P 500 disappoint, that would be highly concerning to me. We haven't seen any evidence of that. We aren't bracing for any evidence of that in the near term.
I have to ask you, John, about systematic funds, because as we remember in March, this market was really driven by technical factors. What does your data tell us right now about how positioning looks like across CTAs, vol control funds, and what does it mean again for the stock market direction?
Systematic funds have had a solid year of performance, and right now they are relatively full in terms of S&P 500 exposure. This is an incredibly momentum-driven community, and right now, as the market moves higher, they will continue to add. That being said, the highest velocity of buying is behind us. If we do take a turn lower, have several more days of what we're going through today, you will see that CTA community start to sell the equity market. That being said, the systematic positioning in the marketplace is very small relative to retail, relative to corporates, relative to hedge funds, asset managers, sovereign wealth funds. So that would be one noteworthy piece of supply. We think all the other sleeves of demand outweigh that in a move lower.
I agree, but at the same time, when they sell, you really feel it because they do it so quickly.
Correct.
So again, regarding today's sell-off, we see that the S&P 500 basically is now trading P/E ratio closer to long-term average. So do you feel that the market right now is fairly priced in ahead of the next earnings season?
We don't think it's overly expensive. We get this question in terms of, are we optimistic on earnings? Yes. We get this question within memory space all the time. And we still think memory, one of the highest momentum sleeves of the market right now, is still relatively fairly priced. And we see that with our institutional clients right now. There's a ton of focus in Korea, in Taiwan, outside of the U.S., and there's still real value to find, even though some of these markets appear to have gone up and to the right. There's still room to run because the fundamentals back it.
Mm-hmm. Hey, John, go ahead, Natalia.
No, please go ahead, Carol.
Hey, well, I've just got to ask, John, we just got about 30, 40 seconds. We obviously want like an hour with you because this is all
Come back.
Incredible. The IPO, Cerebras IPO, that was the biggest. We're getting ready for the SpaceX IPO, Anthropic IPO. Just watching. I know you can't talk specifics, but does any of this smell a little bit like a top of the market, or does it all feel justified and fundamentally justified? And again, just got about 30 seconds.
As of right now, we still think that fundamentals justify what we're seeing go on in the equity market. So yes, we are constructive on our desk. We think S&P 500, we think these dips are buying opportunities, and we think that there's a clear path to 8,000 and beyond this year.
Wow. All right, John Flood, thank you so much. Goldman Sachs partner, head of America's Equities Execution Services. I hope you will grace us with coming back again and joining us. Natalia Kniazhevich, of course, too. And really appreciate it. She is Bloomberg News equities reporter back there at Bloomberg headquarters. Coming up next, we talk FIFA and security, what you need to know. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg, and we have got the Dow, the S&P, NASDAQ very much in the red. Do want to begin with spot gold, though. We've got gold slumping now by 3.5%, ounce of the precious metal at $43.20. But the key takeaway here, spot gold has wiped out this year's gains as jobs fuel Fed hike bets. Right now, spot gold, as I mentioned, down 3.5%, $43.20 the ounce. Year to date, as we check the column there, it is up by 0.01%. All of this as Wall Street's historic weekly run comes to a halt. Stocks are being hit hard today by a tech sell-off. Bottom line here, we got NASDAQ down 1/3 1,010 points, down 3.8%. The Nasdaq 100 index down more than 1,200 points. On that index, a sell-off now of 4.2%, with the SOX now down by 9.4%. Putting it all in context, the S&P is down 169, drop there of 2.3%. Dow Industrials at a record yesterday, now down by almost 500 points, a decline there of 1%. The VIX above 19 with a 10-year 4.54%, the 2-year 4.16%, the 30-year 5.00%. Gold bears repeating, down 3.5%, wiping out the year-to-date gains. West Texas Intermediate crude 90.57 a barrel, down 2.6%. Barrel of Brent, the global benchmark, 93.13, down by 2%. And Bitcoin just above $60,000. Indeed, did see a brief print below 60,000 earlier today. Bitcoin right now is now down by 5.4%. Lululemon Athletica shares now at their lowest level in 8 years after the upscale yoga wear company cut its annual forecast. Lululemon down now by 8.4%. Sachs has won approval to exit bankruptcy after reorganizing. And sports, the Chicago Bears planning to leave Illinois and head to Indiana. After over 100 years, team intends to build a new stadium in Hammond, Indiana. The exact site yet to be selected. Meanwhile, though, a source tells ESPN it is not a done deal, and Illinois can still get back in the race. Recapping, S&P 500 index down 170, drop there of 2.2%. Spot gold wipes out its gain for the year. Tim and Carol, that is a Bloomberg Business Flash.
It is indeed. All right, Charlie Pellet, thank you so much. Well, the FIFA 2026 World Cup kicking off next week across Canada.
Did you get your tickets?
I did not. I don't know that I can afford them.
I know somebody who's going to 5 games.
Somebody.
I'm not joking. A friend of mine is going to 5 games. He's been saving up.
Did he mortgage his house?
He said, I remember I was 7 years old the last time this was in the U.S., in North America. I am going to go. He's going to 4 games that he paid for, and 1 for work that a client is taking him to.
I get it. If you're
all
really
over
into
Seattle, L.A., New York, all over the country.
Also going to games are, of course, our team here at Bloomberg who covers sports. Bloomberg's Vanessa Perdomo-Maglione will be at some of the games as well, and she's been reporting out on what to expect, some of the controversy, because it's not inexpensive to go see some of these games, and there's a lot of issues at play, including security. So Vanessa joins us. Vanessa, of course, she is Bloomberg News sports business reporter and host of the Bloomberg Business of Sports podcast back at Bloomberg headquarters in New York City. Also with us is Dan Arnold. He's Senior Vice President of National Operations at the managed security services provider Protos Security. He joins us from Omaha, Nebraska. Dan, great to have you here with Tim, Vanessa, and myself. Security is a big issue. You've been in the industry for like a quarter of a century. I'm not trying to date you or age you or anything, but you've seen a lot. You understand. You've worked with corporate security. Put the World Cup games here in North America, here in the United States. Give us some context. How do you characterize this event in terms of span, difficulty, and heightened concerns?
Carol, it's a great question. And Carol, Tim, Vanessa, thanks for letting me participate. Carol, you can join me in Kansas City if you want to come watch Messi here in a couple weeks.
I would love to.
Yeah, let's do it. You'll sit right beside me. I'm going to be in the stands cheering with the others. But sitting in those stands, I think that's really where your question, and how do you get safely to those stands? This is like 11 sites across the country, right? In the United States alone, it's 11 simultaneous Super Bowls. And the challenge of security for those environments at 11 at one time is a major strain on public and private, municipal and federal security partnerships.
Dan, I think the interesting thing here is how differently each city is handling it. We've had a lot of cities come out against the funding that wasn't released right away. But how are different cities, in Kansas City, how is it being handled differently than New York? How are each city and the size of those cities go into play here?
Yeah, the funding certainly is controversial and some challenge, but I know what the local folks are doing, and you get private security companies and the public law enforcement, the municipal leadership. I know well over a year, right? There's been very detailed planning, and those groups are very tight and very coordinated. And while they always will want more funds, setting up communication, understanding where forward operating centers will be, understanding how you're going to use technology in and around the venues, different routes, different patrols. How are we going to get people safely in and out of these environments? So the coordination has been very strong, and it's been very exciting to watch these private-public partnerships.
And just so we know, I mean, because of how differently everyone's handling it, is it up to each city to decide how much they want to invest into security? I mean, every city, like we said, it's different. Getting to MetLife is completely different, and having to deal with potentially a Knicks NBA Finals overlap there is going to cost a little bit more, have a little bit more people. So how are the budgets decided there, and how do they spread out this money?
Yeah, certainly with FIFA coordination, there are standards and minimum standards for safety and security. But these venues have great and strong security operations teams, right? They support NFL events and other events. So these venues have a lot of expertise and experience and understand the funding it does take to provide safety and security for these events. But it's important that it's not one plan fits all. And I think that's what's been very good about the local jurisdictions and the local venues to say, routes, like you mentioned, to get to MetLife or get to Arrowhead, wildly different needs in each community, in each market. And so, again, I think the funding's been appropriate, could always be more, but they've been able to design good, safe, solid security plans, in all of these local markets that really fit the local market.
Dan, obviously don't want to give away any secret sauce here, but in an age of where we're seeing drones deployed in ways that were kind of unthinkable in the last few years, it does seem like sort of airborne threats are potentially some of the biggest challenges around the country. How do you think about that and sort of drone technology?
Yeah, I think with drone technology, with the advancements of some of the AI with camera systems and operations in the security space, it has become much cheaper, less expensive to maybe cause some chaos or cause some frustration, right, with drones and other things. People most of the time in good nature want to have cool videos and something for socials, but they don't understand the disruption it causes. And so it is certainly part of the plans, right? There is counterintelligence teams, there are teams with technology trying to monitor, there are flight restrictions around these facilities. And all of those are in place to try to prevent, but it doesn't mean it's 100%. And so the teams have response plans and have been working hard, understanding that some of these technologies and the cost of these technologies have made it a little bit easier to cause a little disruption.
Dan, one thing I want to ask you about that I've been hearing about because of the inflated prices on some of the transportation is that some fans are going to try and find ways to walk to the stadiums. How do you plan for something like that?
Well, it's certainly depends on the market, right? A little harder to probably walk to MetLife than it is some others, but you have major issues with all the just transport in general, right? The public transportation routes, like you mentioned. But as we're talking about pedestrian traffic, the choke points and guide paths that you need to be able to do that safely and securely, not disrupt traffic, is highly challenging. And so they are working very hard to allow pedestrians and others to get to these facilities. It is not the easiest path. It is not usually the common path to these facilities, but there are, I'd say, centrifugal levels of security, right? There are layers and layers of security that start very, very close to the facility. And so as you go out further around.
Dan, we got to run. So apologize. Dan Arnold and, of course, our own Vanessa Perdomo-Maglione. This is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, we are getting ready to enter the last hour of trading for the week, for the day overall. And we are seeing, as we've been talking about, a bunch of selling, certainly on Wall Street. And we've got markets, certainly when it comes to the tech trade, really feeling the pain. But you're looking at a decline of about almost 4.4% on the NASDAQ 100. And you can see the momentum picking up as we get into this last hour of trading, down about 1.2% on the Dow Jones Industrial Average. And Tim, we're down about 2.5% on the S&P 500.
Yeah, I'm just looking at the NASDAQ 100, and even though we're down right now by more than 4%, it's still the only the worst day going back to April of this year, or excuse me, April of last year, Carol, and that was Liberation Day, April 4th, 2025. That's when the NASDAQ 100 fell by more than 6%, so the worst day in more than a year, but still only down to levels last seen since May 19th, so just a couple of weeks ago.
I just got to mention some headlines that are out there because we have been SpaceX crazy as we get ready for that IPO next week, and there was a headline that crossed SpaceX entering a $920 million a month cloud services pact with Google. Let that settle in. 920. We're talking about almost $1 billion a month.
That's a lot of money.
That's a lot of money.
We're going to be all over the SpaceX IPO next hour. Bailey Lipschultz is joining us at the top of the 3 o'clock Wall Street time hour, talking all things SpaceX.
What's interesting is after the end of the year, so after December 31st, either company can end the deal on a 90 days notice. If the company can't deliver GPUs by September, Google can end the deal. I mean, this certainly mirrors what we've been hearing yesterday at Bloomberg Technology, the annual summit. All the voices involved in the world of technology. AI was obviously a dominant subject, but we kept hearing demand. Supply can't keep up with demand. And I just thought it was kind of interesting.
Well, let's talk about some stocks that are on the move this afternoon. I'm Tim Stenivek, along with Carol Masser. Let's take a look at some stocks on the move today. With us is a Bloomberg News equities reporter, Avalon Purnell, with today's stock movers. Avalon, I'm guessing you have a few decliners today.
I sure do. We can go ahead and start off with Meta. That's probably the most frequently named right now. Meta Platforms, that's ticker Meta, currently falling about 5.4%, most since April. And that's after the Financial Times reports that Meta is considering raising tens of billions of dollars in a stock offering to boost the tech company's AI infrastructure. Obviously, this is still in the early stages, and Meta has not yet hired banks to issue the stock, so it's not guaranteed that they will actually pursue this plan. But really interesting to see how big tech companies are really pursuing this AI situation. Alphabet actually at the start of the week also announcing plans for an $80 billion raise to fund its AI spending. And now potentially Meta may be following in their footsteps.
And I guess some would say, though, listen, they have so much cash on their balance sheet that they have the ability to do this equity raise, right? I mean, if they had to, they can certainly tap into the cash coffers. There's some of that at play. But nonetheless, the amount of these offerings that are being entered into, are pretty eye-opening. Let's go on to Lululemon. We've been talking about this name a lot in the last 24, 48 hours.
Yes, Lululemon dealt another blow today. That's ticker Lulu, currently down about 8.2% to hit the lowest intraday level since 2018. And that's after the athleisure maker slashed its annual forecast amid weaker sales trends. The print led several analysts on the street to go ahead and downgrade the stock and also cut price targets. BNP Paribas writing that Lululemon's product launches just aren't working and that the comparative sales remain negative, which makes it tough to remain positive about the stock. Worth noting, though, that Lululemon will be bringing in a new CEO beginning in September. So it'll be interesting to see how she deals with this situation since it's looking like a pretty challenging setup.
She's got her work cut out for her in just a few months when she takes the helm of that company. Okay, you have Meta Platforms, you have Lulu. What else?
Warner Brothers Discovery, ticker WBD, currently sliding about 3.5% most intraday since November. And that's after Reuters reports that several U.S. states are considering and preparing a lawsuit to block Paramount's acquisition of Warner Bros. While it does remain unclear which states would actually want to participate in this, it is worth noting that Reuters did have an interview earlier this week with California's Attorney General, and that person did say that his office would make a decision on whether they would pursue potential action soon.
All right.
Sorry, Carol, there were no gainers.
I have to say,
Sorry,
that's
Carol.
exactly what I was listening out for. I'm like, is she going to give me a gainer?
Nope, the answer is no.
I know. It's a bunch of selling on Wall Street, and we're seeing it really around a lot of different sectors. We know tech, though, in particular. All right, Avalon, thank you so much. Really appreciate it. Bloomberg Stocks and News Equities reporter Avalon Purnell back there at Bloomberg headquarters in New York City. All right, folks, check out our conversation, Stock Movers. They're 5-minute episodes of big winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts.
Hey, if you're sticking with us on Bloomberg Businessweek Daily, on radio, on YouTube, on Bloomberg Originals, we got a great 2 hours coming up here from the West Coast. We're out here in San Francisco. It's perfect to be talking about tech and the way that tech is leading these markets lower. Tom Giles is going to be joining us in just a few minutes, fresh off some great interviews yesterday and Wednesday at the Bloomberg Tech Summit, including with the CEO of Cerebras, Andrew Feldman. We're going to play a little sound from that.
Yeah, and Hock Tan of Broadcom. I mean, talk about a name that has certainly been in the news this week. What a timely interview. So looking forward to catching up with Tom. We're also going to talk a little bit about just the week that was. A very different direction we're wrapping up here on this Friday for the S&P 500. We had 9 weeks of consecutive gains, but it's going to be maybe a different week when we wrap up here. Hey, if you're watching on TV, as Tim mentioned, the close is coming your way in just a moment. Tim and I continuing on Bloomberg Businessweek Daily.